Do you want to know how to take $5 and turn it into $50,000 a month? Well, guess what? I've got the system for you. I was broke 2 years ago, living in the gutter, drinking my own urine because I couldn't afford to buy myself any water. But then I had a good mind thought and I was like, hey, oh my goodness, this is occurring to me. And I used my mind and I made $10 million in the first year with money I borrowed from someone because, as I said, I was broke and I lived in the gutter and I couldn't afford anything. But hey, now I am so happy and rich. I'm in the Bahamas and everywhere, and I want to teach you exactly how I did it. So just sign up for the free course and I'm going to spit a bunch of bullshit at you about nothing, garbage crap you can't implement, but I will have a book and some other guide and my super secret system only available for those who register for the free course. And then you can spend your $1,000 of hard-earned money and you can have my system and make $50,000 a month. And you know what the best part is? I didn't even have to use a gun to your head to rob you of your money. What's going on, guys? I'm Jordan Dubois, lightninglister.com. In this video, I want to discuss not scam scum like that, but investors and presenters that I see on the internet, on conferences, and various other areas that they come out of, and the way they discuss investing and the problems with it, the psychology that they set you up to believe and that you think is just fact. And we're going to talk about it in a dramatized way, and it's going to be fun. And I'm going to just present it to you how I see it normally presented as fact, and with the lack of a disclaimer that, hey, if you invest, be prepared to lose everything. No one sets up and starts off their video like that or their conference like that. They're just like, hey, you want to make money, you got to do it this way. And like I said, the first scam scum illustration, that was total BS, but still people who follow that and fall for that are most of the times, what I've observed, desperate. I've had family members that have fallen for that trash, scum, garbage spewed out of these pieces of crap's mouth that I would rather see die than lead desperate people in need and desire to be helped, and they don't know how to manage their money, but they're following these idiots and they're wasting their money and making idiot wealthy while they suffer and they can't afford to take care of their kids. And it's just very, very hurtful and garbage trash, and people like that should not be able to talk. So in this video, I'm not going to focus on those kind of people. Like I said, I'm going to focus on the investments that maybe someone who doesn't have a malicious intent is trying to convey to you, how to invest, but they're still wrong because they start off on the wrong foot without the disclaimer that I said, you can lose your money doing this. And they don't present it as a guess. Everything that they say when it's involved, when investments, is a guess. Doesn't matter what people tell you, just sit there and think about it for a minute. How do people know what's gonna go wrong or how to calculate stuff? So the topic today of discussion is investment risk, because I wanted to make investment videos for my YouTube channel and on the website lightninglister.com and write some articles and stuff like that. But I feel obligated as a witness of family members who have gone through, tried to invest, thought they knew what they were doing, and really just did not understand that investing is gambling. It doesn't matter what you calculate. It's not set in stone. It's not gravity, and it's just a gamble. And that's what you have to know. So, like I said, I'll present this, then we'll critique what's wrong with this. If it's not obvious and apparent, which, to a lot of people it's not. So we'll critique it. Then we'll go over my 2 principles that I really believe will help you if you want to invest or if you want to do any of that stuff, put your money to work for yourself, because I invest, but you have to go into it with the mindset that it's a guess, it's a gamble. Even when you start off making a business, it's a gamble, it's a guess. You have to try to make your best guess, but it's a guess, okay? I want to stress that. So before you watch any other investment videos, consider these ideas and my opinion and do with it what you will. All right? So listen all the way through for my 2 simple principles. Oh, I sound like the scam scum, but they're gonna help you and set you up for investing correctly and not losing everything you have right away and just dying and hanging yourself. Okay? So let's go. Hey guys, I'm Joe Blow. I'm an investor. I make tons of money. And check this out. Today, we're gonna talk about investing the intelligent way, all right? Intellectually, how you should invest, the things you need to know to keep yourself safe and on the right track, all right? Let's talk about it. Investing, specifically risk, the risk of investments, all right? Let's talk about it. What is risk? We gotta define that first. Well, risk is defined simply as, let's say you have a set point of money you want. Right here, that's that set point on that line. It's the amount of money you want to make, whether it's 10% on the money or whatever. Let's just assume, for simplicity's sake, but none of this it's very set in stone, very good. But anyways, 10%. So you invest $1,000, you're gonna make $100 back. That's math, that's right, 10%. And the risk is now what you don't want to happen. That's over here on this side, this area right here, bad stuff. Don't want that. That's why it's red, okay? That means that anything lower than that 10%, that's gonna be bad. That's what you don't want. It can be negative stuff. It can be 2%, negative 20%. And we'll go over, how you calculate that exactly and be confident and have a great feeling in your stomach after you calculate it, and then you're ready to throw all your money at these investments. So the 2 investments we're gonna talk about today, the investment risks associated with them so you can invest smart, are real estate and the stock market. And we'll talk about other stock market things like, investing in stocks specifically or index funds, all that good stuff. So here we go. Real estate. Now we want to know the probability of losing our money or not making enough money. If our heart's set on 10 or 15% and we have the probability of making 5%, should we really even do that? Whoa. All right, so let's talk about this math equation. It's math, it's proven, math has proofs and probability and it's all cool, and you've seen the normal bell curves. I'm sure you know, okay, but let's go over this. Real estate, this is the equation for the probability associated with getting less than we want. All right, ready? We got VRE equals total risk. You can memorize this as VRE. Oh, what's the probability in real estate, Joe Schmo? Oh, it's simple. It's VRE. And you can calculate it. Check it out. So V is the vacancy rate probability. R is the repair amount probability. And E is the economic probability of disaster. So how do we get these numbers? Well, we use very sophisticated, educated ways of making the numbers come out of thin air. So let's check it out. It's really easy. Watch this. All right, so V, vacancy rate. I asked my real estate agent, Jeff, to go into the MLS and look up vacancy rate, historical vacancy rates in the area that I'm thinking about spending my money in. So actually leveraging other people's money, which is, the best way to go, but we'll talk about that. So I was like, Jeff, tell me what the vacancy rate is. He was like, all right, got you. Oh, looks like it's 5%. Oh, how many properties did it take you to calculate that vacancy rate? 3. Oh, that sounds great, man. It's better than 1 or none. So, well, what do you know? 5%. We've solved for one variable. All right, now repairs. I talked to a whole forum of investors, and you know what they said? They said, Joe, somebody, this is what's up with repairs. Budget 5%. 5% for repairs. Now, is that 5% for the whole year? Like, I'm going to have half a month out of 12 months for repairs, or am I going to 5% of the income? We'll just do 5% probability. So what? Okay, 5%. Oh, dude, that's 2 variables solved. Oh my God. All right, we just need one more and we're on our way to financial success in real estate. Here we go. Economic. Okay, let's think real quick. Let's be reasonable, logical, intelligent, and educated human beings. The economy, it tanks once every 20 years. What do you know? That's 5%. Oh my God, these numbers are amazing. Wow, 5, 5, 5. You know what that is? 5 plus 5. 5 plus another 5. That's 14. No, not 4. 15. 15% total risk. That means that if you invest in real estate, you're looking at only 15% probability of this shit happening that you don't want. So if you invest 100 grand, 15% means 15% of the time you'll lose it. And we're not going to infinity. We're just one sample, you and your property. 15%, that's good. Oh, that's great. Okay, we covered real estate. Now you're a pro. You can go run all the calculations and all the things and you need these numbers. Okay, now let's talk about the second way to make money. Okay, here we go. Stock market. Now, in order to be financially savvy in the stock market, you got to know the risks associated, and let's calculate them real quick. And we're using economist ideas and Nobel Prize winning. Okay, here we go. We've got 4 measures up here, all right? 4 sophisticated measures of risk in the stock market. Now, in order to be good little investors, you want to diversify. You want to be diversified in everything. You want to have global economy markets, index funds, this and that and all that. And Vanguard said this and that. So we're going to go with their advice and do investing and all of the diversification that we can get. And since we got four different measures of risk, we can pick the one that we love and makes us feel good in our stomach. No. Okay, let's go. Standard deviation, beta, value at risk. Oh, these sound good. Conditional value at risk. All right, now these are all based on the historical data. What is this magical historical data? Well, it's just little price points that people took note of. They're like little analysts, and they're just like, okay, well, today the stock price is $5. Tomorrow it's $3. And they did that every single day. Okay, historical standard deviation. Now, all that is really is just an expected value. Say the stock was $100 on average. So they used an arithmetic average. Again, they used math. What is an arithmetic average? Well, it's so easy to calculate. It's like 1 plus 2 plus 3. If each of these were the day's prices, and then they divide it by the number, that's 3. That means 3, 5, 6, that equals 2. Okay, that's algebra. That's basic. And the expected value, they did all that, and it came out to be 100. But we're educated investors, so let's look at the risk, okay? Risk. All this red stuff right here, this is what we want to avoid. This is risk right here. Ugh, so bad. So, how do we calculate it? Well, we look at the standard deviation in this measure of risk, and it's simply just whatever the stock price bounced around at. So all these numbers up here, we say, okay, well, 1, that's a certain level, certain distance away from 100. 2, that's a certain distance away from 100. We factor it all in using math, proven math. It's good, you know, you're gonna be, and we calculate this. And it could come out to negative 20% and 20% or whatever numbers make you feel good because, so you do that, and the standard deviation tells you that, hey, you know, you could vary and wiggle around to negative 20 and 20%. So, okay, so that's standard deviation. Beta, that's another historical measure, okay? And it's no big deal. It's just, measuring the price bounces and the ratios of a stock compared to the standard index like S&P 500 or whatever, whatever you want. Pick two indexes or a stock, do the geometric mean and just stick it in there and you'll have beta. Value at risk, same thing, at historical risk. You can calculate it, whatever number you come up with, you're good. And that's how you invest smartly using your brain. All right, ladies and gentlemen, let's talk about what is obviously wrong with this way of thinking right as soon as you start investing and why people are wrong who present investing this way without first disclaiming that you can lose your everything on this. You can lose your shit, you can lose your house, especially if you invest with money you don't have, like Joe Banker taking out a loan on stuff to invest on margin or whatever you want. That's just, that's a whole nother issue. But first of all, real estate, calculating this stuff. Yeah, I calculate stuff too. But as I said, it's a guess. It's a guess. And it's historical. And on websites like Vanguard and all those, the commissions that govern those websites and stocks and everything, FTC and all that, whatever, SEC, whoever's the governing boards of all that, they make the people put on their websites that, hey, historical measures of anything are not future indicators. What does that mean? That means that they don't know what they're talking about. That's it, really. You can measure all the historical stuff you want, but at the end of the day, it's a guess. It's the best guess we had, but it's a guess, and it means you could lose your shit. How do I know? Look at history, at all the bubbles and all the stuff. If people were so educated and so great at guessing this stuff because the math is all perfect, then those people would not lose their shit. But there have been so many people that have put too much of their money every month into investments, and their investments tanked and they killed themselves. It happens, okay? 2007 and 2008 and all that recession, tons of crazy stuff happened. People killed themselves. So you can't sit here today and forget that. That's just nuts, And when I hear people wanting to leverage money for real estate and, you just get some money, put 10% down and you're good to go and you can use other people's money and that's ridiculous. Because if you're leveraging other money and you don't have money do you have money to afford multiple mortgages? Can you afford paying off the house in case you don't get vacancy rates of 5%, or they destroy everything and you're left with it being vacant for the time that you fix up the house and paying for all the repairs? Can you afford that? Most people can't. And most people who get suckered into investing do it wrong. All right? The calculations are guesses. And you need to know you can lose everything you put into investing. Stocks, they got a bunch of really fancy things and people have won Nobel Prizes, but it should all still be saying, hey, disclaimer, risky as fuck. Okay? That's what it should say. We don't know what we're talking about. It's our best guess, all right? It's uncertain. We don't know uncertain. I don't even know tomorrow what's going to happen. No one does. Okay? So all this stuff is wrong, and that is the issue, and that's the problem with it, that people, even if they're, like I said, not trying to be harmful or have malicious intent, they still present this stuff like psychologically it gives you the impression that you can do this and you're okay because the risk says you're okay, the risk calculations. But no. And that is what brings me to my first principle of 2. So if you get nothing out of this video except these things, then, and it helps you avoid blowing all your money and just one person it helps, then I'm happy I made this and happy that I helped that person out. And the first principle is this: invest only what you can lose. That means that if you allot 10% per month out of your post-tax income, which is what I recommend, because taxes and stuff, things might change later and you might spend and owe more taxes. Invest only what you can afford to lose, to throw away in the trash can, because guess what? Your investments might lose everything that you put into them And as long as you're not investing on margin, that's it. That's the bottom line. That's the max amount you can lose. That is my first principle. Before trying to calculate anything fancy schmancy and trying to convince yourself that everyone knows what they're talking about because they're mathematicians and blah, 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 do that. That first principle, invest what you are willing to lose. And you need to determine right up front if you're okay with losing 10% or 5%. And if you're not, take your money and put it in a high yield savings account and just save it, because the only risk there is the bank going out of business or the government not paying and backing up on their word. And when things get that bad, it will become depression-like status and it'll be bad for everybody. So, I mean, that's the least riskiest that I can think of, investing, putting your money into a high yield savings account. Okay, if you're not ready to invest, you don't have the money, or you're not willing to lose it, high yield savings account. It'll help you kind of outpace inflation, hopefully, if it's a good one, like Wealthfront offers. And other than that, that's the first principle. Invest only what you can lose financially and emotionally. Principle 2, and my last principle of the video, and sounds kind of cheesy, but it's so true. Invest in your brain. And the way I like to present it is, investing in the brain is always a gain. Isn't that awesome? That's so great. So invest. Get yourself a diploma. Go to school. Get a diploma that you can utilize if your entrepreneurial ventures don't pan out. I was lucky, okay? I was very lucky. Things lined up and I was able to become an entrepreneur and have a successful company even before I graduated with my degrees, okay? But I got degrees in fields that I felt were had very good outlooks in the future, and I will make more videos on how to pick great degrees and what to do in college to get yourself set up right, because I made some mistakes and there were lots of people I saw make mistakes, and because of that, they had very difficult times getting jobs. But they did get jobs and they pay really good money, okay? So that's principle number 2. Investing in the brain is always a gain. Principle 1, invest monetarily what you're willing to lose emotionally and financially. And 2, invest in your mind. It's always the way to go. Don't listen to people who tell you that, nah, college is a waste of time. Going and getting educated, it's a waste of time. You just gotta sit back on your ass, listen to my system that you paid $1,000 that you saved up your whole life for, and you'll be good to go. You'll be in the Bahamas. Woo! Oh, God. I hate those people. They don't deserve to be able to vocalize anything, and don't listen to them. I want to live in a world where people think critically because it makes it great for everybody. Poverty always sucks. It breeds crime and violence, and no one likes living in the ghetto, and no one wants to sit in the gutter because they don't know how to handle money. And I've seen it happen in my family, and it was hard, and I've hit hard times. And just don't listen to people who give you this crap advice to invest in their systems or invest without knowing that you can lose your crap, because that will be the bad downfall way to go, and you don't want to do that. I'm Jordan Dubois with lightninglister.com. If you like this kind of content, no BS, then consider subscribing to my channel or come back once in a while. The benefit of subscribing is you get notified when I make new videos, and I plan to make a ton of what I think are awesome videos. So let me know what you think. Put a comment down below. Let me know if you agree with me, disagree with me. Throw up a math formula, literally puke it out in the comments, and let me know what your favorite math formulas to think that you're calculating risk as. And if you like this video, give it a thumbs up. It doesn't cost you anything except one little click. So you can just click it and move on. All right. Thank you so much for your valuable time. It is extremely valuable, and I really appreciate you watching this video. Take care.